Morning guys, Joel Frank here, market analyst for YouTrading. In today's video, we're going to be taking a quick look across markets and talking about the key news events that have been driving things this week, what's been going on, and what could happen for the rest of the week. So I think, get rid of these lines. A good place to start is probably with the dollar, which you can see continues to languish at or very, very close to recent lows. Looks very much likely it's going to test the year-to-date lows that it hit earlier this year, just below 101, currently around 101.50. What's been going on that's driving the dollar lower? Well, there's been a series now of significantly weaker than expected US data releases this week. So it started off on Monday with the ISM manufacturing PMI, which came in below expectations and pointed to a US manufacturing sector that is in recession. Prices paid index was also deflationary, as you can see there. On Tuesday, it's not on this calendar, but we did also have weak manufacturing output data out of the US. Today, before we move away from Tuesday, this is important. Tuesday saw the number of job openings in the US, according to the JOLTS report for February, falling below 10 million, below expected, which was 10.5 million. And I think that actually that is the lowest now in 2 years. You have to go all the way back to, well, that August report would actually be for June 2021. But maybe not 2 years, but the lowest in a long, long while. And then today, let me just get rid of that chart. We've had the ADP non-farm employment change figures come out, also significantly weaker than expected. So manufacturing sector in the US is doing badly, and the US labor market is showing some signs of cracks. So this has really led to markets upping their bets that the US is headed for recession later this year, as the lagged effects of all of the Fed's tightening that they began just over a year ago finally start really being felt in the economy. Of course, this narrative could change on a dime if Friday's official labour market report comes out a lot hotter than expected. That could switch up this narrative, at least about the labour market. And the upcoming ISM Services PMI release, which is going to be released shortly today, if that comes in significantly hotter than expected, then that could also change some narratives about the US economy by saying that, yes, okay, at least maybe there's some weakness in the manufacturing but services remains robust. So we need to keep an eye on this data. But for now, it's weighing on the dollar. It's weighing on yields. This is the 2-year yield, which has been moving lower. Looks like it's probably going to hit fresh year-to-date lows, lost its grip of its 200-day moving average. The 10-year about to make an important breakout, potentially below some recent lows in the 3.3 area, opening the door, well, to where? I mean, all the way down here, potentially 2.5%. I mean, if the data continues to turn in the US, if bank crisis concerns resurface, then, in the next couple of months, and I think this would take months and months and months, perhaps it would take all year, maybe not quite that long if things do get really bad. But perhaps a move all the way down there is on the cards. Of course, weakness in the dollar, weakness in yields. Gold is loving life. If you go back to my trade idea video yesterday, I called this one pretty well. Actually, potentially happened a little bit sooner than I thought. I thought it might be the ISM data or the Friday jobs data, weakness in one of those that was going to trigger a pump higher in gold. But we got the bullish breakout of this pennant structure that I flagged. And it looks like we're now going to test gold's record highs, basically, which is in this 2070, sort of 75 area, because there's no technical resistance anyway. So that means, easily can post in like another 2% gain here. Oil still being held up for now. You got the dollar weakening, which is helpful. You've also got the OPEC output cut, which is keeping things well supported above where oil was at the end of last week. But as the macro narrative worsens, I mean, let's just draw up this resistance area. You got those support term resistance zone from sort of late last year to early this year, 200-day moving average. As the macro narrative shifts negatively, it could be difficult for oil to get above this area. Now, if the supply picture starts getting really tight, like, you don't want to rule this out, because we need to wait and see what the effect of these OPEC cuts are on inventories and all that kind of stuff. We're going to need to be monitoring all of this. We're going to need to see how US demand and Northern Hemisphere demand actually for fuel as the driving season approaches, basically as summer arrives, how all of these things turn out. But I think for now it could be quite tough to break above this level. Finally, stocks. Usually we don't look at stocks last, we look at stocks first, but you can see stocks here pulling back a little bit from recent highs. For now, concerns about a recession outweighing hope that the Fed is done with its rate hiking cycle. You can see, oh, that's a messy chart. Let's get rid of all that. The uptrends in these, let's go back to the S&P 500 though, actually. The uptrends in the medium term in these indices, though, does remain in play, I think, anyway, for now. Now, that could shift if recession concerns do get really, really bad and the Fed isn't perhaps seen as going to do enough to support the economy, blah, 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 blah. Perhaps if inflation data remains sticky, we do have inflation data coming up soon next week. In fact, let's have a look. We got it. It should be next week, shouldn't it? Yeah, US CPI next Wednesday, PPI on Thursday, retail sales as well, preliminary University of Manufacturing data. That's all next week. But let's just look at one last thing quickly. You can see the probability of another interest rate hike from the Fed only now seen at 37.8%. At its next meeting in just under a month. Now, you can see 1 day ago that was 44% or 45% basically. So in the wake of the weak data, that has continued to pull back. And if you remember back to 1 month ago, prior to the bank crisis, the collapse of those 3 US banks and the big response from monetary and fiscal policymakers and everything, and prior to this worsening of the US data, it was seen as certain that they were going to do another interest rate hike, and there was a probability that we're going to be taking interest rates to 5.25 to 5.5%, which would have implied at some point, maybe at the last meeting or maybe at this meeting, that there could have been a 50 basis point rate hike. So yeah, that's just a reminder of the swift shift that we've seen in Fed tightening expectations. And by the way, this 37.8% chance being assigned to another rate hike, that's like the last expected hike. Like if we go out to July, the current rate is 4.75 to 5.5%. We're actually pricing in more than a 50% chance now that there's going to be a rate cut from current levels by July. And what about June? Are we pricing in a rate cut? We're pretty much thinking that we're going to have held, and there's a small chance we might have lifted interest rates. But that's just incredible, isn't it? That there's nearly a 50% chance, or more than a 50% chance, that there's going to be a rate cut by July, according to these money markets. If we go to December, the probability is kind of centered around interest rates being cut all the way down to just below 4, almost bang on 4, or just below 4.5% from current levels. So potentially up to 100 basis points worth of rate cuts by the end of the year. That's what markets are saying right now. Whether this can come back in to support equities, I mean, it has been supporting equities. You can see the NASDAQ 100 index still close to recent highs. Same with the S&P 500. Whether that can continue to support against recession fears remains to be seen. But that's where we are right now. Back to the calendar though, because what else has been going on? Couple of things. We had an interest rate hold from the RBA. We had a slightly bigger than expected interest rate hike from the RBNZ to 5.25% from 5%. which caused a short-lived spike in the Kiwi. Tomorrow, we've got the ISM Services PMI coming out of the US today, which can be very important for the macro narrative. If that comes in weaker than expected, we're not just talking about a weak US manufacturing sector, we're talking about just a weak US economy in general. Even you're going to see these recession bets go even higher. Fed tightening bets pulled back even more. Dollar fall even more. Yields fall even more. Equities, don't know what would happen. Gold, pump. Crypto, potentially pump. Depends on how bad things get for equities, if they do get bad. But anyway, moving to tomorrow, nothing out of the US really. But there is jobs data out of Canada, and then obviously the US jobs data on Friday. Also keeping an eye out for Fed speak. There should be a smattering throughout the week. But that's pretty much it, guys. That's what's been going on so far at the middle of the week. Hope you all enjoyed the video. Hope you all found it informative, and I will see you all in the next one.